Hello, welcome again. In this video we're gonna take a look at Starbucks. It's a company that a subscriber of the channel actually asked to take a look at. And it is a company that I actually hold myself. I've been holding for a while now. Very well known company, exists pretty much everywhere. It's a big thing in the US. I have lived in the US for many years. There's a Starbucks everywhere pretty much. And so you can also find it in Europe quite a lot. At least where I'm living right now, it's still a thing. And a pretty big one also. So we're going to take a look at the company, see how they are doing right now and what is happening with them. Now, the first thing that I wanted to examine is the stock news, the news for the stock. And you will see this first article here pretty much telling you why is Starbucks down today. And the reason for that is that the CEO announced that the company would halt its buybacks for Starbucks. So that's a big thing, obviously. It really affects potential investors. So let's take a little bit of a look and see what's happening with a chart, actually, of the company. And Starbucks is a company that is actually paying dividends. And the first thing that you can examine here is the fact that they are paying a dividend yield of 2% right now. And the payout ratio is at about 50%. Which is okay, but kind of marginally. I mean, it starts to become a little bit of a burden. Still, it's easily payable from Starbucks, but it's important to have that at the back of your mind, just to know where you are in terms of the payout ratio. It's still fine, though. I mean, they should be able to pay it without much trouble. Now, the next thing that we will examine here, we can kind of see the monthly chart is the default here. And if you take a look at some actual data before that, you will see the 1 year data here, the 5-year data. You will see how far along Starbucks has come since 2017 over here. And the max chart is even more. You will see when it started back in, look at this, 1994. So this is very handy to see how the company has progressed through the years. Very neat. But if we go back to the 1 year chart, you will see here that the company's 1 year low has been 78, but the 1 year high has been 126. And so we're sitting close to the lows of the company and not the high ones, which is a potentially interesting purchase point. But let's take a look at the financials here. The company has a P/E ratio of 24.7 right now and a 22.4 price to free cash flow ratio. And you will see that both of these metrics are actually going down, which is generally speaking a good thing. You want these to be as low as possible, really, in terms of their price, in terms of their ratio, really. So the outstanding shares, which is another great thing for the company, they are going down, and they are going down massively, 20% in the last 5 years. Again, you will see here that in 17 to 19 they bought a lot of shares, and they would be buying more. This is what they canceled, and this is why the stock price is down right now. Now, the free cash flow to total liabilities ratio points to how many years of last year's free cash flow we would need to pay back the total liabilities, all the total liabilities of the company, and that would be about 8 years. You typically want this to be at about 5, as I'm mentioning here, but it kind of depends on the company and what kind of risk you are willing to make. It's still worthwhile to know how much free cash flow the company is making, how many the total liabilities are. This is why I have it here. I really pay attention to this number here because it really quickly tells me how much debt the company has. And the 5-year revenue growth here is increasing, and that's also a good thing. Same thing with the net income growth, although not much. They did have a slump here in 2020. I'm assuming this has a lot to do with the pandemic too. And the same thing with the free cash flow growth. They also had a little bit of a slump here. The 5-year total equity growth, though, is a little bit troublesome here. You'll see that it is actually going down and in negative territory. That's because the company got a lot of debt, as we will see a little bit later. But it really pays to very quickly evaluate these key metrics here and see that the total equity is going down, because now you can kind of examine what happened there and why this is a thing and whether this is trouble. We will examine that. Now, the next thing, you will notice here that the debt to equity ratio is negative. These returns on equity will be negative because they are losing money right now. And we examine the dividend yield. The next thing that I want to do is take a little bit of a look at the financial statements of the company, try to understand what's going on here. So the net income, you will see that there has been a massive decline here, especially in 2020. The net income went down massively, but 2021 it seems like it's returning back to normal and then some. So that's good to see. And the balance sheet of the company, remember we examined that they had negative equity, you'll see that here, from 5 billion to minus 5 billion. They had a lot of liabilities. Look at the increase, 9 billion here to 36 billion in the next 5 years. So that's an insane increase in liabilities. And you will see it here. See this very, very handy table here describing the debt. They used to have 4 billion, now they have 24 almost. So a huge increase in debt, as you'll see. This is what actually causes the liabilities of the company. The insane increase in debt. Look at that. Long-term debt here, 3.9 to 21.3. So debt increasing and increasing. They do get a lot of debt. Now they do have, remember, 37 billion in total liabilities here. And if we go to their cash flow statement, they did make at least last year 4.5 billion. And this is exactly what this very, very handy key metric was about here. Remember when we examined it a little bit earlier, what we saw is 8.12. It would take 8 years for the free cash flow to match the total liabilities. And so if I go back, if you multiply this by 8 point whatever that was, you get the total liabilities number, which means that it would take 8 of these years to pay all the total liabilities that the company has. And this is a little bit of an interesting metric because it tells us now if the company really wanted to clear the debt, how much of their free cash flow they'd had to reserve for that. Of course, they're not going to do that, but it's a useful metric to actually tell us how much debt you have in relation to the free cash flow that you're making, because it really matters how much free cash flow you can actually use to repay your debt. It's a metric that I pay attention to. However, yeah, they do have a lot of debt, but the 8 years of free cash flow, I wouldn't say it's a really big deterrence for me. It wouldn't really deter me from buying the stock, although it does play a role and it does increase risk. So bear that in mind. I mean, it does add a little bit of risk because of that. And yeah, this is how a tool of that sort can actually tell you a story very quickly here. So this key metrics here of the company, these key metrics here really tell you the story of the company just by looking at those and being able to read the numbers here. And then you can visit their financial statements to discover the finer details. Very handy stuff. So the next thing that we will examine here is the stock evaluation tool. And we will try to see how much we should be willing to pay for the company if we want to buy it today. And to do that, we need the averages, how much money the company is making, what their margins are, the net income and the free cash flow margin. You will see here that the revenue growth has been relatively the same in the past, like almost 3 years ago back, but starting back in 2017 really. And we will go with something like 4, 6 and a little bit more 8 here. We cannot go too much because we had negative years as well. Probably we don't expect that again. This happened because of the pandemic. I'm pretty sure these are the pandemic years. So I would expect this to actually be low projections here. Very conservative, frankly speaking. We may even want to go a little bit more. Actually, let me go a little bit more. I think this is very conservative, too conservative probably. So I'll go 6, 8 and 10. But the net income margins, you will see that again, typically we have like 12, 18 and 14. So I'm gonna go 10, 12 and 14 here, always slightly conservative. The free cash flow margin, we're gonna go 90, 100, and let's go 105, which is pretty much the last year was 107. This might be a little bit too much actually. And the annual return that I typically want to make is about 13% for any stock really that has a similar risk. If we're talking about a riskier stock, I like to ask the tool for more. So let's calculate here and see what we're getting. So you will see here that the current price of the stock right now is 86.91, which is even down 5%. Yet we are far from even the high estimates here. So if you have bought Starbucks much earlier, you are fine. But at this price, it's a little bit of a problem, I feel. It's a little bit expensive. I think if I'm not mistaken, I bought it at around 60 or so. I could be wrong. It's been a while. But right now, I think it's a little bit of a stretch to pay that much for the company. It's a little bit overvalued. It does come out of the pandemic. There is a little bit of potential here for the company, but I probably wouldn't pay this price today. I think it's a little bit too high. Now, again, the revenue growth that we used is 10%. You may have a point about more, but the thing is, 2017, 18, and 19 were actually less. It was actually less than 11%, and this is our high is 10. So I think it would be a bit of a stretch to even try more than 10%. So hopefully that gives you ideas about Starbucks. It's a company that I personally like a lot. I am a big coffee aficionado myself. I drink coffee all the time. Pretty much have one nearby right now, and I do like Starbucks. I mean, it's not bad at all, and it's also a very fine place to go out to with your laptop and stuff. So it's a place that I totally dig actually. But in terms of the stock, I think it's a little bit expensive right now. I would wait for it to go down a bit and then revisit. Hopefully that video helped you, and if it did, please leave a like. That really helps with the YouTube algo. And remember to subscribe, because at some point I will let you know how to access this tool. And it's soon. That's gonna happen in about a couple of months or so. Hope you enjoyed the video, and if you did like this one, you may want to take a look at the one that I made earlier, and it's about Twitter. Actually, Elon Musk bought a large stake on Twitter. And so this video, I think, is going to be useful to you because you can see whether it's actually a worthwhile buy for you and your portfolio. And thank you for watching this one again, and I'll see you soon. Bye-bye.